Let's take a look at an example with a company that lists its own financial statements. We have here income statement, a statement of owner's equity, balance sheet, and statement of cash flow. In this small case example, I'm going to demonstrate how each line of transaction is going to affect and change each of these financial statements. Now here we have a One Piece, a small company launched operations on January 1st, 2018. And these are the activities that took place in the month of January. The financial statements will be prepared as of January 31, meaning it's 1 month's transactions only. The very first transaction here says invested 5,000 as a capital. Now investment, if we have to again prepare a sort of brief analysis of these transactions. So we have again assets equals liabilities and equity. Invested 5,000, so the owner invested 5,000. That's going to mean that the company has 5,000 in cash. So we're going to have increase of 5,000 in cash. And we have a capital as well. So we have cash and 5,000 of contributed capital invested. So in case of the balance sheet, we have a change in sort of both sides of the equation. So we have a change in cash assets and the contributed capital, the equity side of the balance sheet. So for now, let's leave it as such. So we have effect on the balance sheet. Technically, we could immediately look into the statement of cash flow. So here we have again 3 activities. So operating, investing, and financing. Investment by the owners, that's clearly a financing activity, and therefore we have inflow from financing activities of $5,000. Let's move on to the next. We have here bought supplies for $1,000. So if we buy something that's clearly outflow of cash, so we're going to have a reduction in cash right here, minus $1,000. And we're going to have a purchase supply, so supply assets will be created. So we have now distribution of assets into sort of cash is reduced by 1,000 and supplies increased by 1,000. Again, the balance of liabilities, equity, and assets is equal to each other. And at the same time, in the statement of cash flow, we can say that in the operating activities, we had outflow of cash minus 1,000 of the supplies that we have purchased. So clearly here we have an outflow of cash. So again, we have effect into 2 financial statements, balance sheet and the statement of cash flow. Moving on to the third transaction, we have borrowed 2,000 from a bank to buy printing machine worth 10,000. So we used, so here in this line, we can see that there are 2 transactions actually taking place. One is we borrowed money from a bank, $20,000. So if we borrow money, that's inflow of cash. So the cash in the asset section will increase by $20,000. Simultaneously, that's also a loan from a bank. So it means that we have borrowed money from the bank. So that's our liability. So it doesn't mean additional inflow, but it's just a liability from the specifically borrowing it from the bank. So if we see our balance, total assets equals total liabilities and equity, so everything is correct. And immediately again with the same transaction, specifically borrowing 20,000, we can say that there was an inflow from financing activities of 20,000. So we have increase in cash because of financing activity. So as you can see, while we're preparing balance sheet and the statement of cash flow, we will continuously notice that the cash will equal the end cash balance in the statement of cash flow. It means that we have considered all of those transactions in both financial statements. So again, we have borrowed money from bank, only 2 financial statements, meaning balance sheet and statement of cash flow will be affected. And the second transaction in the same line, we have purchased machines, so printing machines worth 10,000. So we used the cash that we had borrowed. So 10,000 is going to be minus, so we're going to reduce cash by 10,000, and we're gonna buy a printing machine of 10,000. So we replaced one cash with the other one right here. Yeah, so we have printing device 10,000, cash is reduced by 10,000 as well. Let me click on it so you can see. Yeah, and again, the total assets equals total liabilities. Because this transaction involves cash, again, we can look into the statement of cash flow. We have an outflow of cash, and purchasing printing device is a long-term asset. That's an investing activity, and therefore we're going to have an outflow of 10,000 because the money is out. We spent money on this device, is going to be recorded in the investing activities. So again, if we look at the total and cash in the statement of cash flow, it says 14,000. Cash balance in the balance sheet is also 14,000. So far, we have no other financial statements to be mentioned just as yet. Next, we have, so with the printing machines, we usually need to consider depreciation by the end of the month, but we're going to, for simplicity's sake, not mention it whatsoever. We're going to disregard it, and only once we cover depreciation, we can work on this as well. Moving on to the next transaction, we have paid 6,000 rent in advance for a year, and 1 month already was occupied, has been occupied. Yeah, so in this case, again, we have two transactions. One is we have paid cash for rent in advance for a year, and the second one is that we have used the space for 1 month. There are two transactions that took place. Now let's first deal with the payment for rent. So again, if we pay cash for rent, that means an outflow of cash of 6,000 is minus. And we have created the date when we paid $6,000 for rent. We've created an asset of prepaid rent. Yeah, so money out, cash out, and prepaid rent. So the asset, the benefit of which we still can use for 12 months, is created. So again, we have balance of the liabilities and assets, 25,000, 25,000. And immediately we can record the statement of cash flow. We had an outflow of cash, that is the operating activities, and specifically for rent. Yeah, so that's going to be an outflow of 6,000. So that's the outflow of cash minus 6,000 again, and cash is equal to the cash in the balance sheet. The second half of this transaction is irrelevant for the usage of that space that we have occupied. So usage of that asset means an expense. And where do we record expense? We record it in the income statement. Now, how much of that should be expensed? Now, 6,000 has been paid for 1 year in advance, means 12 months. So 1 month's worth of rent is $500. So it means that at the end of the month, as of January 31, we have used 1 month of rent, which is equal of 500. So there's an increase of $500 of expense by the end of January 31, right? So $500 will be an expense. In case of the balance sheet, what happens here is that our prepaid rent, the one that we've paid 12 months ahead, clearly now has reduced. Again, we're preparing a financial statement as of the end of January 31, right? So there has been a prepaid rent reduction. How much have we left? So 12 months we had paid in advance, 1 month is by. It means that we still have left 11 months worth of rent, and each month costs 500, and therefore we have now left only, let me actually make it as a formula, minus 500, because 500 has been used. We still, by the end of January 31, we have still left $5,500 worth of prepaid rent. And again, if we look at the total assets and liabilities, there's already this balance right here. We know from the analysis of financial statements that increase in the expenses reduces our equity, and the equity in this case is retained earnings part of it. So we have a reduction in equity or retained earnings specifically because of increase on expense. So 500 will be reduced over there, so 24,500 will be our total liabilities and equity. And I had a formula installed right here, so the retained earnings will for now show the net income. Now it's kind of confusing because in fact this is not retained earnings, this is net income. And let me just retype it. In our specific case, it will be equal to retained earnings because the drawings and dividends are non-existent in this list of transactions, and therefore the drawings will be zero, and therefore the net income will be equal to the retained earnings overall. Yeah. So either way, we have here a sort of equalizing effect because of the formula that I have input right here. Next, we have what the next transaction will be, just to mention very quickly, the statement of cash flow clearly with the second half of this transaction, meaning the 1 month has been occupied, is not going to be in effect because no cash is out, right? So we have already considered the cash that we've paid for the rent in advance, and that was already recorded as minus, outflow of 6,000. But the second half has nothing to do with the cash outflow, so we'll leave the statement of cash flow out of this. The next transaction is customer A, meaning we had a customer who ordered to print pamphlets and flyers for 10,000 on credit. We assume, of course, that we have completed the job, and so we're going to recognize a 10,000 on revenue. And so if the revenue is recognized, we record it in the income statement, $10,000. Because again, there is an effect on equity. So customer order to print, we've completed the job, that means increase in revenue, so 10,000 recognized. We can immediately say that it's going to increase our retained earnings. That's increase in the retained earnings because of that. And in the other hand, we have an increase, and in this case it says on credit. It means that the revenue is recognized. We didn't receive cash, but we have created an accounts receivable of 10,000. There is a liability or other liability from the customer. In other words, it's our assets that they are promising to pay us in no time, and so we will have a 10,000 accounts receivable. The second transaction is similar to that one, except it's a customer B who orders prints menus and 5,000, and it's also on credit. So here again we have increase in revenue. We're going to record 10,000 was the first one plus 5,000 for the second transaction on revenue. We have increase over there. Retained earnings also increase by the same 5,000. Because the revenue increases the equity, in this case through retained earnings, and therefore we record it here as well. And we also create an accounts receivable for the same amount. So we already had 10,000, now we have 5,000 more, so in total 15,000. Again, total assets equals total liabilities. Statement of cash flow again is unaffected because these are on credit transactions, this one and the previous one as well. Moving on to the next transaction, individual customer orders totaled 5,000. So we had multiple individual customers. Each of them made their payments in cash, and therefore we're going to recognize as well, 5,000 in revenue because we've completed the job, so revenue increases. We have an increase in retained earnings because the revenue increased, right? So again, following the statement accounting equation analysis, right? So we will have increase in retained earnings, 5,000 over here, this next one. And we're going to have increase in cash because this time the customers have paid us in cash. Since the payments have been made in cash, we can immediately recognize the operating, so cash inflow from operating activities, and that's going to be 5,000, and we're going to recognize it right here in the statement of cash flows. Based on this last input, end of cash balance, statement of cash flow balance equals 13,000, which is also equal to the balance sheet cash balance. Next, moving to the two more transactions, we have pays employees 2,000 wages. So we've paid our employees 2,000 wages, and that means that's our expense, and we recognize expenses in the income statement. Now wages are recognized right here. What does the expense do to our accounting equation? So the higher the expense, the lower the equity, so retained earnings will decrease by 2,000. And since we've paid it, we're going to have a decrease in cash as well, because we made the payment. And because it's cash involved, we immediately also input the change in the cash flow. and that's going to be outflow from operating activities, specifically payment of wages. Next, we have spent $1,000 worth of paper expense. So we had the supplies expense in this case, yeah, so I have different names, but exactly the same. So the usage, so we bought in this transaction right here supplies of paper, and then we spend them. Spending them means using them or expensing them. So the $1,000 will be expensed in the income statement, which is going to decrease our equity minus 1,000. Yeah, we have used the expense, means negative equity, and we don't have asset of supplies anymore. We had it, we used it, and so we have now zero supplies because it's all gone. So total assets equals total liability and equity. We have all financial statements pretty much recorded. So we have 11,000 balance cash in the balance sheet, and the statement of cash flow balance is also 11,000. Just a couple of more corrections. I believe I forgot to input the investments by the owners into the statement of owners equity, which was original, yeah, these 5,000, where it is invested, yeah. So the owners invested 5,000, that's going to be inputted here. So we're gonna write it down, and there are zero drawings. We didn't have any drawings whatsoever, and so that's going to calculate accurately our statement of owner's equity, if I'm not mistaken. Yeah, so there doesn't seem to be anything missing. So we have retained earnings 16,500, which is incidentally equal to our net income this time, and net income in the income statement is also 16,500. So I believe this completes the analysis of financial, so our transactions from months and their effect on the financial statements. So this helps you to see the big picture. It helps you to see how each of the financial so each of these transactions affects each of these financial statements. Now, clearly, we will not be doing this throughout the semester because the idea is that no company prepares its financial statements this way. We have way too many transactions to consider. So the next step will be to cover the double entry bookkeeping, which is the very effective system of recording each transaction and only then preparing financial statements. Yeah. But this exercise helps you to understand how one line of transaction will affect and change your financial statements